Now, first of all, let me welcome you to mindyourinvestment.com. My name is Siddharth, and in today's video, we talk about Fundamental Analysis Series 2.0. Now, initially, we had a Fundamental Analysis series. It is the most viewed series all over YouTube about fundamental analysis. It had only 8 or 9 videos. This is the latest version, and this has around 25 videos which we'll cover in this series. Now, this is going to be more immense. We'll talk about the basics first and then we'll go to the advanced level. But if you have seen that series first, then I would recommend that you watch this one also, because this is the latest version with latest data, and this will help you understand and clear the doubts that we had in the first lesson or first series. Today's topic is the balance sheet of a company. Yes, balance sheet, the most important part about fundamental analysis. And if you learn about balance sheet, you can start doing fundamental analysis from today itself by looking at just this video. So let's get started with fundamental analysis. We talk about balance sheet. I'll quickly go for a second, show you what fundamental analysis is all about within 1 minute, and then I'll explain what balance sheet of a company is all about. So I'm all suited up so that I can explain what fundamental analysis is to you in a very professional way. Now, what does the word fundamental mean? When we talk about fundamental, it basically means something which is of base and core importance to a factor. What is the factor over here? The factor over here is what we call the company. So when we talk about fundamental analysis of a company, we talk about the company's events, the company's financial statements, the company's industrial structure, all of them. If we combine together, we do an analysis of that. That is what we call fundamental analysis. Now, what you need to understand about fundamental analysis is that this doesn't change overnight. Like whatever value that we get from fundamental analysis, it is called the fair value of a company. And this value doesn't change overnight, unlike the technical analysis, where with every day or every minute, the price of the company is changing. With fundamental analysis, there is a price that is being estimated based on the company's earnings, what the company will make today, what the company will make tomorrow, what the company will make 1 month or 3 months from now. In technical analysis, we use the company's price trend and estimate where the company's price will go. So there's a big difference between technical analysis and fundamental analysis. Now, why would you use fundamental analysis? You can only use technical analysis, correct? Because that's more accurate. It is more real-time based. The problem is when you look at companies like Yes Bank, Suzlon, companies which collapsed overnight, these companies had some flaws in the fundamentals. That is why the companies failed. Let's say you buy a share. The company's share price is going up every day. But the problem with technical analysis is that you do not know when would you exit the company and book your profits. Because with technical analysis, you do not know how much the company will go, how much the company will fall. With fundamental analysis, we know what is the fair value of the company and what is the value at which the company is supposed to trade at. Is the company overvalued at times? Is the company undervalued at times? All this you understand from fundamental analysis. So here are a few things that you need to know about the balance sheet analysis. Number 1, it is the first step of fundamental analysis. Balance sheet analysis is very easy. It only takes 3 things that you need to consider. And as we go forward in the video, you'll understand how easy it is to read the balance sheet of a company. Second, it helps us determine the financial health of a company. Whether the company that we are investing in can be invested for the next 1 year, 2 year, 3 year or 10 years or not. We all find this from the balance sheet of a company. And thirdly, this gives us the core outlook of the company for the future. Is the company safe for investment or not? Whether the company will go bankrupt in the future or not. We all get to know this from the balance sheet of the company, and that is why this is the first step and the easiest one to get started with. So what are the topics that we'll cover in today's video? Number 1, where to find the balance sheet from. Number 2, how to read the balance sheet correctly. Number 3, examples of a good company, average company and a bad company using balance sheet. Real life Indian stock market examples. And finally, doubts and queries from series 1, all of them I'll answer at the end of the video. Now if you want, you can skip to different parts of this video, but I would recommend watching the entire video so that you understand the concept properly all over again. So now let's look at the place where you can find the balance sheet data from. Now we have two places in India. I would prefer Screener.in website, and the other one is Money Control. Two very good websites where you can have the data available for balance sheet analysis. Now I'm going to show you Screener.in. This is one of my favorite places. We use this website and the data from this website for our analysis. It's very easy. All you need to do is go in this link, it's in the description, open it, and once you see this, you have to first click on the search for a company box. Here you will search the company that you want to analyze. So let's say we want to analyze Hero MotoCorp. We'll click on Hero MotoCorp and you will see this screen. Once you see this screen, you have to scroll down. All the data is about the company's prices, then pros and cons about the company, quarterly figures, profit and loss, balance sheet, all of them are here. In this video, we're looking at the balance sheet of the company, so we'll use the balance sheet data. And similarly, if you look at moneycontrol.com, here in the search and code box, you search the company's name. Like let's say we are doing Hero MotoCorp, we'll search Hero MotoCorp, we'll scroll down, and over here we'll click on financials. Once we click on financials, you'll see the balance sheet tab over here. You can read all the data from here as well. I would recommend you use Screener.in website. That is much easier to look at and it's less complicated. So we'll refer to Screener.in's data going forward in the video. So let's quickly understand how to read the balance sheet of a company. Now on the screen, you'll see that we have two balance sheets. One is from Screener.in, another one is from moneycontrol.com. Now both the balance sheet in this picture is from Bajaj Auto. We are showing you two options where you can read it from. Now in a balance sheet, we only require three things to be read, and these are in the liability side of the balance sheet. One of them is share capital, another one is reserves or surplus, and third one is borrowings. Now on the screen, you will see that in the Screener.in, we have all of them, the three ones listed properly together, marked in the red box. And in Money Control, you see that we have four boxes here because the liabilities has been split together. It also accounts for other liabilities in moneycontrol.com. I prefer Screener.in because there only the important borrowing, which is unsecured loan, that is mentioned there. But in Money Control, it doesn't happen like that. If you see the company's actual books, reports that they announce in their website or any other portals like ET Now, Yahoo Finance, or any other websites, you'll see it is very similar to what Screener is using, whereas Money Control has a different way of calculating. So I would prefer you follow Screener.in. That is much more easy to read and much more simple to understand. So now let's look at the balance sheet factors and how do we read them. Now we know that we have to read share capital, reserves and borrowings in a balance sheet. But what do they say and how do we find which company is good for investment, which one is average and which one is bad? Now when we talk about a company, we call the company to be a person. If we compare a company with a human being, then it becomes much more easy for us to analyze the company because then we can relate to it. Now let's say a company has share capital. That would be similar to a person's property or assets that he or she has. It can be family inherited wealth. It can be things that the parents have given them, things that they have acquired over the years. That is property or asset. Now for a company which we called reserves is very similar to a human being's savings. This reserves is like what a human earns and keeps in the bank for emergency purpose. A company calls that reserves. And a company's debt is what we call a human being's loan. So if I buy a car on loan on EMI, that is my loan. A company takes loan for setting up properties, for buying vehicles for their production, their factories and all these things. So loan is debt in a company, and for a human being it is the personal things that we take, like buying a mobile phone on EMI, buying a house on EMI, buying a car on EMI. So on the screen you'll see that we have a list. We'll get to all of them as we move forward in the video, but let's understand what this says. Now, for a good company, the share capital of a company shouldn't dilute too much, as in it shouldn't increase too much or expand too much. It should always be in a single range. The company's reserve should always increase consistently. The more the reserves of the company, the better it is for the company. And finally, company's debt. The debt of the company should be falling. Now, this would be an ideal investment for long term. Now, in an average company, you will see the company's share capital is increasing a bit, which is not a very positive sign. The company's reserves is increasing, which is again positive. And finally, the company's debt isn't going down, it is almost stable. This would be a sign of an average company which you can hold for medium term or short term. And finally, if we talk about a company which is poor or bad, here you will see the company's share capital is increasing tremendously, the company's reserves are falling, and the company's debt is going up. This is a sign of a company that you should avoid for investment unless there is some short-term play. If you invest in the company for 3-4 months because the news of the company is strong, then it is ideal. But to keep this company in your portfolio for long term is not ideal. I'll show you with proper examples. So now let's look at a few examples of the Indian companies for balance sheet analysis. We'll first look at a good company, then we'll look at an average company, and then a bad or a poor company. So on the screen, you'll see that we have two companies here. One is Hero MotoCorp, another is ITC Limited. Now, both of these are good companies. And let's find out why are these companies good companies. So the first thing that we'll see is the company's share capital. What we can see here that the company's share capital of Hero MotoCorp in 2014 was 40 crores. From then till March 2021, the company's share capital was intact. It didn't dilute at all. It was 40 crores. So this is a very positive sign for any company. Second, if we look at the company's reserves, it was 5,583 crores in 2014. From there, it went up to 15,376 crores in 2021. So the reserves of the company has grown tremendously over the last couple of years. Now, if you look at the company's debt or borrowings, we can see that the company's borrowings in 2014 was 284 crores. From there, the company's borrowings have increased to 584 crores in 2021. See, the borrowings of the company has increased, but what we have to see here is the proportion of reserves to borrowings. Now we can see that the company's reserves is 15,376 and the borrowing is only 584 crores. So it's less than 5% of the company's reserves. In such a case, it is quite obvious that this company will not face any situation of bankruptcy and this company can easily pay off this unsecured loan in a minute or whenever they want. Well-placed companies generally take unsecured loans just so that they do not have to spend money from the revenue, so that they can retain the revenue for profit sharing or for reserves. That is why some companies take small amount of borrowings from the government or from the bank. Now, if you look at ITC, here we have a different situation. ITC share capital in 2010 was 382 crores. From there, the company's share capital kept on diluting, and in 2021, the company's share capital was 1231 crores. So you will think that the company's share capital is bad. Well, actually, the reason for dilution of the share capital can be of many reasons. One of the big reasons why companies' share capital dilute is bonus shares or ESOPs. Now, if the company is selling their shares or diluting their shares so that they can give more shares to its employees or to its shareholders in the form of bonus shares, then we can say it is still a decent move. But you will see in the news that some companies sell their shares so that they can raise more capital to run their business. That would be a very bad sign. So for this company, we can say that this is share capital wise an average stance. Now, if you look at the company's reserves were 14,076 in 2010. From there, it went up to 59,116 in 2021. So automatically we can see the company's reserves have gone up. Again, it is a very good sign for the company. And if we now talk about company's borrowings, it was at 111 in 2010, and in 2021 it is 271 crores. Now, again, if we do a comparison, the company's borrowings or debt is less than 1% of the company's reserves. So again, we can say this company is a very strong company balance sheet wise and has very low chance of going bankrupt. So these companies become ideal investments for long term because they do not have any chance of going bankrupt going by the historical data. Now if we look at an average company, then we can see that we have Apollo Tires and Ultratech Cement here. So let's look at the situation first and then we'll understand why are these average companies. The company's share capital in 2010 was 50 crores. From there, the company's share capital diluted a bit to 64 crores in 2021. So this is again a very good sign because the company's share capital didn't dilute too much. And if we look at the reserves also kept on growing from 1917 in 2010 all the way to 11,380 in 2021. And if we now talk about company's borrowings, it was 1707 in 2010. It is at 6,434 in 2021. And if we compare the ratio of reserves to the borrowings of the company, then we can see that the company's borrowings is above 50% of the company's reserves. In such cases, there is a chance that these companies may face a problem in paying off its debt. But in India, since India is a growing economy, a lot of companies you'll see that they have quite a bit of debt. But if the debt crosses the 50 or 60% mark of the reserves, then that would not be an ideal company for long-term investment. We'll find that in the bad company section. Now if you look at Ultratech Cements, here we can see company share capital diluted from 124 in 2010 to 289 crores in 2021. So that is again an average sign. Reserves of the company, if we see, it was 4,494 in 2010. It went up to 43,886 in 2021. Now if we talk about the company's borrowings, again here you'll see it went from 1,607 to 20,488 in 2021. So again we can see that the company's debt is close to 50% of the company's reserves. So again we would say it's an average company, but we all know Ultratech Cement is a big company in India. The reason why we see the balance sheet of the company is average is because if you compare this company with companies like ACC, Shree Cements, which are these companies' competitor, then you will see that they have lower debt. Maybe because Ultratech is expanding their business more and entering different segments, that is why the debt is high. But just the balance sheet is not one big factor. There are other factors like profit and loss statement, other quarterly figures, ratio that we'll cover in the coming videos. But based on balance sheet, Ultratech Cement has an average balance sheet. And now if we talk about bad or poor companies, we have two examples. One is Suzlon, another one is Ashok Leyland. Now Suzlon is a company that we covered in our first series. You must have seen the video. We said what will happen to Suzlon because at that point in time, company was trading at 15 or 16 rupees per share. It fell down to 5 rupees a share just a year after we made the video. There were reasons. We covered that in the first series. If you have seen that, you can verify that by mentioning it in the comment section. Now, if we talk about Ashok Leyland is a surprise because it's a very big company in India. Everyone knows about Ashok Leyland. Why is this company in this list? Let's find out. Now, company share capital, again, like I said, in Suzlon, if you see, here it was 314 in 2010. It went up to 1702 in 2021. So this company has sold a lot of its shares in the past couple of years. And the biggest reason for selling these shares were because to fund their business. If you find the news of this company, why they are raising more money by selling shares, then you will know. These are bad situations and these are the companies that we should avoid for long-term investments because these companies are selling their shares to fund their operations. The day-to-day activity of the company are funded by selling shares. And now if we talk about the company's reserves, it was 6,274 in 2010. It went all the way to minus 12,075 crores in 2020, and now it is 5,381 minus. So this company's reserves is negative, as in they do not have any reserves. They're running on negative reserves, as in their account is empty, they're running on bank overdraft, or there are other parameters that makes the company's reserves negative. They do not have any savings, like I said, in their bank so that they can fund operations. Now if you look at the company's borrowings were 12,668 in 2010. From there it went up to 13,210 in 2020, and now it is down to 6,925. Now the reason why this company's borrowings reduced, maybe because the company sold a lot of its shares, the company's reserves were again adjusted. So a lot of factors might have caused the company's borrowings or debt to reduce. But overall, if you see the company's situation, it is not ideal for long-term investment because of negative reserves and debt being this high. For this company, if they want to pay off its debt, it doesn't have any money. It would have to take more loan to pay off the existing loan it has from other banks and governments. Now, if we talk about Ashok Leyland, here we'll see company share capital is 266 crores in 2014. In 2021, it is 294 crores. So share capital wise, the company is good. Reserves of the company was 3,723 in 2014. It is at 7,568 in 2021. So reserves is also company is good. But the problem here is with the borrowings. The company's borrowing is 8,500 crores in 2014, and the company's borrowing in 2021 is 24,077 crores. So here we can see that the company's borrowings is almost 300 times more than the company's reserves. So it would require 3 times the company's reserves to pay off the company's debt. But since Ashok Leyland is one of the biggest companies, it has a lot of orders from government for making vehicles for the army, and again state-owned buses and government buses. That is why we have to look at other parameters also. Balance sheet wise, this company's balance sheet is not that strong. If this company had a short-term obligation to pay off its borrowings, the company will suffer because the company doesn't have enough funds in its bank to pay off the company's debt. So generally companies like this have a chance of going bankrupt, but because this company Ashok Leyland belongs to the Hinduja group, they have a strong parent company, there is very low chance of these companies going bankrupt. Similarly, Tata Motors balance sheet also, if you see, it has tremendously high debt and borrowings. Why? Because they are setting up more plants, they're setting up more factories all over the world so that they can supply JLR cars, Tata Motor cars, and setting up EV vehicles. So their debt is also very high, but the chance of Tata Motors also going bankrupt is again very low because they have a very strong parent company, Tata Sons. So there are a lot of fundamental factors which we'll see going forward in the series, but going by the balance sheet, Ashok Leyland, yes, definitely has a very bad balance sheet, and just by balance sheet analysis, this would not be an ideal investment for long term unless the company's borrowing starts going down. Now, before we go to our next slide, let me quickly take 1 minute of your time and explain what products can you find on our website. The first one is the fundamental analysis Excel sheet, which has 10 different analysis models along with 8 custom situations which will automatically calculate a company's fundamentals, whether the company is suitable for investment or not with a score, along with 3 different target prices. Now this model is for those who are starting off with fundamental analysis. You should definitely try it. It is only for $389 and you can download it unlimited times once you buy the package from our website. The second package is the stock valuation Excel sheet. This is our premium Excel sheet. A lot of investors use this and they get the most accurate target price using this one because this has 8 valuation models used by top brokerage companies all over the world. These have an accurate way of calculating the fair value of a company, and with this, every quarter you get a target price of a company. And not only that, you get a Telegram community along with this where we discuss stock market valuations, stocks recommendations which are supposed to do well in the next quarter, future and option strategies, stock market recommendation, and other things that we discuss in the community. All of this is for lifetime. And finally, don't forget to check out our seminars on fundamental analysis, technical analysis, and future and options. Here we have a course where you can learn directly from me in a video conference in a trading platform where we do an interaction. It is a 3 to 4 days learning course where we teach you how to do individual topics correctly. You will learn a lot if you are starting off. If you learn something from this video, you learn 10 times more than that in these seminars. So if you're new to our channel, definitely give these a try as well. These will give you the highest possible return. So let's quickly answer the doubt and queries we had from the first series that we made on fundamental analysis. So a lot of people had this query that what is share dilution, and if share capital increases, what does that mean? And how does this affect the company's share? Now, when we talk about share dilution, what you need to understand is dilution basically means that the amount is increasing because it is diluting. So whenever we see in a company's balance sheet that the share capital is increasing, that would mean dilution. पहले 10 था, अभी 20 हो गया. The company's share capital got diluted from 10 to 20. That is not a good sign. Now we cover in the video what are the causes of dilution. There are multiple reasons for dilution, but in general, if the company is raising capital by diluting shares, that would be the worst possible case for the company. If the company is giving out bonus shares or ESOPs, then we can say it's a good sign. Second is some companies have high debts and low reserves, yet they are at all-time high. Why? Now you will see that a lot of companies in the Indian stock market have a lot of high debt because they are in the expansion phase, they are setting up factories, and their reserves are also low. Like I said, Tata Motors, Ashok Leyland, two big companies where balance sheet are not that good, yet the companies are at all-time high levels. Why? Because there are other factors of fundamental analysis which we also have to look at. Generally, like I said, if you want to invest in a company for long term, you should never invest in these companies where the debt is that high and it's much higher than the company's reserves. Third question, which one to use, consolidated or standalone balance sheet, and what is the difference? So consolidated balance sheet basically means all the units the company has or division the company has, may be outside India or other divisions of the branch. When you combine all of the things together, all the companies together, and then have a balance sheet, that is what we call the consolidated report. Standalone report would be just the operations in India. If we look at that balance sheet, that would be the standalone data. A lot of companies do not have consolidated data. Some companies do not have standalone data. So preferably if you have consolidated figures, use that. And finally, does this work on the banking and NBFC stocks? The answer to that is no. For banking and NBFC stocks, there is no need to look at the balance sheet of the company because it is a financial company. There are other parameters that we have to look. We'll cover that in the later videos. But for any other segments of the company, may it be auto companies, IT companies, anything, cement companies, every other company is where you look at the balance sheet. Just the NBFC and the banking stocks are the ones that you cannot look at the balance sheet for analysis. So that is all that we have for today's video. If you have any doubts regarding the topic that we spoke of, don't forget to WhatsApp us on this number. Along with that, don't forget to check out our premium Excel sheets available on the website with the webinars.